Hey guys, what's going on? This is Kyle at Projection Hub, and today I'm going to be talking about what are 7 kind of common pitfalls that people who are trying to apply for an SBA loan application sometimes fall into, and it can impact the strength of their application and kind of weaken their chances for approval. And so I'm going to go through what those 7 items are, as well as give you some examples and some ideas to mitigate those things so you can strengthen your loan application. As I said, my name is Kyle. Before my time with Projection Hub, I was an SBA loan officer for almost 7 years. And since I've been with Projection Hub, we've gotten the chance to help thousands of businesses create financial projections and business plans for their SBA loan applications to help them go through that process. And so during today's video, while I'm going through those 7 steps, I'm going to show a bunch of free resources you can use. I think there might actually be one for almost every single kind of point that can help you during your kind of SBA loan application process. And if at any point you like the video, give it a thumbs up. That really helps us as a small business, and consider subscribing to the channel. We have a lot of content around, applying for SBA loans, starting a business, running a business, financial projections, business planning, you name it. And if you have any questions, just leave a comment down below the video. We're very responsive down there, and you can also just contact us directly at support@projectionhub.com. We would love to help you with anything we can related to your SBA loan. So without further ado, let's go ahead and jump into what are the 7 common pitfalls of applying for an SBA loan application. All right, here we are. Now, as I mentioned in the introduction, I'm going to use several different kind of tools and resources and things to show you and demonstrate these kind of 7 kind of key mistakes people might overlook or might make when applying for an SBA loan. So we want to make sure you kind of have your bases covered there. Several of these points will have some sub points I just tried to categorize them together a little bit. So you can see I got a lot of tabs open here. I'm going to show you some different things that I think should be really helpful. So first thing I have up here is our free SBA loan application checklist. We'll have all of the resources I show you will be linked down in the description below. So the video is also, got chapters so you can hop through different sections if you'd like. So you can grab a copy of this if you are considering or exploring the SBA loan application process, which I'm assuming you are if you're watching this video. This is going to be a great resource. So even you can see right off the bat, all these are links to different resources and guides and videos and all kinds of different things. And we've got lots of videos where we go through this in depth, or I go through this in depth. So you can seek that out as well. But the very first point I'm going to mention is people may not realize that there are different types of SBA loans. And so the first common mistake is picking the wrong type of SBA loan. And to your credit, and to startups and small business owners everywhere, it shouldn't be your responsibility to have to know what an SBA loan is and all the different nuances and the types of loans to get. So I get it. That's really frustrating, and can be a confusing system in general. And so I'm going to try to do a short, sweet version of that here. And again, you can look up more content on this additionally. And really this probably boils down to kind of picking between what I think are 2 different options. And so in general, there's kind of 3 main buckets here: SBA microloans, 7A loans, and a 504 loan. If you are an established business, or the thing you're trying to start is going to contain, a large facility, lots of equipment, that kind of thing, then 504 is a decent place to start. That's where I would go. So if that sounds familiar to you, and it's going to be, a large facility, large piece of equipment, that kind of thing, larger dollar amount, 504, you should check that out. The next biggest bucket of SBA loans are going to be what are called 7A. So like if you would go to a bank and they would participate in SBA lending, which most banks do, they're going to offer 7A products. 7A has several kind of sub programs within 7A. And so it can go from $500 all up to $5 million. They've got there's a brand new kind of line of credit, working capital loan, which we just made a video on that. You can find that one too. It might be popping up on the screen or linked below. But so there's a lot of different functions for 7A loans. Those are going to be what are called SBA guaranteed loans. So that's going to be the most common thing. So the main thing that I think is an oversight for people is most people don't realize there's a thing called an SBA microloan. So especially if you're starting a business, maybe if you're an existing business too, but you're relatively confident that you're not going to need more than $50,000, I would not go 7A. I would go microloan. Most people don't even know microloans exist, and that's because they're not depositories. They're not banks. A lot of times they're nonprofits. They're local organizations. They're at the maximum statewide, but usually they're, chunks of a state, cities, multiple counties. And the reason I point that out is because they're going to have a much more personalized process, higher approval rates, more, I don't want to say banks or anyone else are unfriendly. That's not the case, but it's just going to be a much more like mission-based experience. And so the only reason I call it a mistake is because I think you're leaving some benefits on the table when it comes to like approval chances and additional resources. A lot of those microlenders have grant funding so that they can give you coaching resources and all these other free additional help. So that's the first point I'm just going to make is it's these 3 general buckets. If you are looking for large facilities, large pieces of equipment, check out 504. If you are a small startup or just need to get a single piece of equipment or some working capital or something like that, and up to 50,000, below 50,000 sounds like a good space, check out microlenders. I'm going to show you some more tips on where to find the right lender, but you can even already see in this checklist, we've got some resources on where to find these types of lenders. And then the rest is going to be that 7A. So if you're an existing small business, most generally you're going to be in this 7A, and then 7A has some of these sub kind of loan programs that you can figure out while talking through your lender. So don't be afraid of point 1. You're not going to probably accidentally end up in the wrong bucket. It's just making sure you're aware of, most generally, you're going to naturally come across 7A, but this microlender and 504 are a good option too. So that's point number 1 is, pick the right SBA lender. That's a good starting point. Number 2, picking the right SBA lender. So now once we've got the types of loans kind of sorted out, where do we go to find those lenders? And again, this checklist has some really good resources. I'm just going to show you, I'll show you 2 quick things. One, if you're like, yeah, that microloan sounds kind of nice. These 2 lists are going to be a really good place to start. So I'll even just show you as an example for one. Not to get into the weeds because we don't need to do this on this video. CDFI stands for Community Development Financial Institution. And it's just a different certification for these small organizations. And a lot of CDFIs are also SBA microlenders. So they've got this nice little filtering tool down here. You can go to micro enterprise. You can say, your state. So I go to Indiana, which is where I live. And then we do, like a loan fund. So that's where you can find some of these. It'll give you some links like Bankable. This was the lender where I spent 7 years as a loan officer. And then another link that was on here, just the straight up SBA microlender list, put in your state. You can find which ones in your area and you can check out their website. Again, they take a little bit more research just because they're not a bank and they don't take deposits and they're going to have some different products, but it's worth the time. The main thing I want to show you, because this applies to most people, is that 7A loan we were talking about, which is going to be the one that can go up to $5 million. So this is going to be the bucket a lot of small businesses fall in when they're looking for an SBA loan. That's primarily going to be facilitated through banks. And we've got this nice tool here that we've built. It's free to access this. You can get access down in the description below. But we've taken a bunch of publicly available SBA loan data and we've put it into this nice dashboard tool that you can kind of interact with it. And the thing that makes this great is we can put in a few different filters and we can see like who is making loans to my type of business in my state, right? Because that's going to be a good starting point. So a common mistake people will sometimes make is one, just assuming like their hometown bank is going to do their loan or someplace they've had a relationship. If you've had a deposit account for 20 years, some people assume that that increases your chances of approval. That's probably not really the case. A lot of it comes down to the speciality of the bank. Like, do they have an appetite for that type of loan or that industry? The portfolio weight. There's a lot of different things that you don't know in there. So let's do just an example here. Like if I say Indiana, and then let's say car wash, and let's say I'm an existing or more than 2-year-old business. So now I can see, look, there's only 2 lenders in Indiana that have made an SBA loan to an existing car wash. And whatever this is, just a few years of data. So while there's not a bunch of different options, or these aren't clearly like the most experienced, they've at least done it before, right? So that could be a great place to start. Now, and if we go to a state more like California, where it's gonna be a lot larger and there's a lot more businesses going on, you can already see how that jumps up, right? So you can play around with this and find, if you have no leads on a lender or conversation started yet, this is a really good place to start because it can give you, 1, 2, or 3 lenders that actually have some experience with your type of loan. And actually, we've got a pretty wide network. So if you do this tool and you find out, which bank might be a good lead for you, let us know. And we would be happy to try to make an introduction for you to those lenders. So that is common mistake number 2, is overlooking that the lender actually matters. It's not all of these different lenders that access into the same kind of pool when it comes to the SBA. These lenders are still applying their own review processes, their own lender appetites, their portfolio risk, all of these different things that they have, their expertise still applies, even though, it's got kind of that SBA backing behind it. So that's point number 3, is picking the right lender. Again, you can access tools like this, link down in the description below. Point number 3, let me hop over here. And that's going to be, is your business plan too long and not enough detail? So it's kind of a common misconception. And the reason I pulled this up is, again, linked in the description below. These are all free business plan templates. So you can come to our website, you can get a free business plan template. Most of them, we have a video on how to create a business plan done by me, going through it top to bottom, giving you a whole bunch of points in the free template, tips and tricks on how to make your business plan ready for an SBA loan. But a lot of people think that the longer your business plan, the better it is. And coming from the loan officer experience, I would actually say that's not the case. Unless it's a very complex, business acquisition idea, and there's just a lot of really important content that needs to be in there, then there can be a case made for that. But in general, I would say the longer it is, the more likely the important details are going to get lost in the sauce, right? It's going to get too muddy. Your loan officer is not going to read every single word in your business plan. They're not going to do it more than once. So if you can stay in that 20-page, 25-page max length of words, not including like if you got pictures and stuff in there, that's of course going to make it longer. And then you want to make sure what actually makes it in there is detailed. We want to avoid generic sounding information. So some examples of that could be, and I've got a few kind of subpoints on this section, and that's going to be, when you're outlining your goals, short-term goals or long-term goals, don't say things like, in the short term, we want to be successful. And in the long term, we want the goals to be the number 1 car wash in the state of Indiana. Like, those don't really make sense because they're not super measurable. It doesn't really give the reader any insight to what you're trying to accomplish or what are markers of success. So better ones would be like, at the end of year 1, we want to break even and be profitable. At the end of year 3, we want to open our 2nd car wash location in Fort Wayne, Indiana, right? So some very specific measurable markers, and apply that same theory to the whole business plan. You want to be specific and measurable wherever you can, and not generic, because generic is forgettable, right? Some other examples in your business plan: be sure to demonstrate that you as the owner has relevant experience and skills, so you know what you're getting yourself into and you know what you're doing. And if you lack any sort of experience or skills to be starting a business or growing a business in the area that you are, that would give your lender concern, make sure you supplement your skill set with partners, key employees, key managers, that kind of stuff. So you don't want them to have any doubt that you don't know what you're getting yourself into. Another point is make sure you have a detailed competitor analysis and some market analysis. I think we actually just published a video on how to do this, like, for free, and ways you can make that section really good in your business plan. So I would consider checking that out. Don't be the people who say, no one does what we do, we don't really have any true competitors, because that's not true. Every person has a finite number of dollars and time, right? So they're going to be choosing to allocate that money somewhere else, even if you don't have a direct competitor in that case. And then the last point in that is make sure you demonstrate how you're actually going to get customers in the door or acquire customers, rather than just say things like, we're going to have a website and people will show up, or we're going to advertise and people will show up. So we got more content on those kind of pointers, but that wraps up number 3, is keep your business plan short and sweet and as detailed as possible to make sure it is useful. Number four mistake: avoid complexity and keep it simple. Now I'm going to bring up a LinkedIn post to give you an example here. So this is Adam Hooksma. He's the founder and owner of Projection Hub. He's been an executive director of an SBA lender for over 10 years, did over 1,000 SBA loans. So he kind of knows what he's talking about on the other side of the table. And he says, keep it simple. So some people, when they put together their business plan, they have this tendency to dream really big and put that all in their business plan. If that needs to be an exercise for you to map out your entire future for your business, you should do that and just have your own copy of that. The copy that you hand to your lender should be a simplified, refined version where you only need them to get on board with what you need today, what you need to get started. So his example is, if you wanted to buy one truck to get your trucking business started, your projections, your business plan should be focused more on making sure that the business works on that one truck. And even if you had hoped to add 10 more trucks to your fleet over the next 5 years, you don't have to say that in your startup business plan. If the business makes sense, much smaller than that, and that's what it takes to get a deal across the finish line, that's what you should focus on. Even if you know in the back of your head, your plan is to expand this thing and add more trucks. You don't need a lender to buy into 10 trucks over the next 5 years if what it really only requires is to get them to agree to one truck right now, if that makes sense. So keep it simple, only ask for what you need today to get started and to still be able to prove that you can be successful with what you're just asking for today. Hopefully that makes sense. Point number 5, or mistake number 5, is underestimating your cash flow needs. Now, I'm going to bring up a set of financial projections to show you this. And maybe I should just let me just show you this for now. And that's going to be, so when let's say we're using a startup as an example here, and you determine you're going to need, well, in this example right here, this is like a gym. I think maybe in the specific example we put together was like an indoor, like rock climbing gym. Okay. So if we go over to some of our assumptions and we see like, these are what our startup costs are going to be. So, let's say if we go to this tab right here, we're going to say we've raised $540,000. So a lot of people will think about all the things they need to buy and, equipment or renovating a space or all these things, like their upfront starting costs. But a lot of times what people don't think about is the ongoing cash flow. So most businesses aren't profitable on day one. Most businesses aren't generating enough cash on day one to pay for everything that they need. And especially if your industry has long cash flow cycles, like if you have to wait 90 days to get paid, those kinds of things, make sure you understand the cash flow of your type of business and that you're going to have enough money to account for that cash flow upon launching. So in this template right here, this projection template, this set of projections, it was calculated. Not only are they going to need all this money just to get started, but they're going to need some extra money to cover their losses until the business can take care of that. So you need to make sure you're not underestimating that cash flow needs and using a tool like this. So just to make sure I'm not being too confusing, this is a projection template. We've got like 120 or 130 of these on our website now. Let me just pull it up for you. For various different industries, if you're starting a daycare or a dental office, we have a template geared for specifically existing businesses or acquiring businesses or trucking businesses, whatever you can think of, that allow you to create your projections for yourself. All of these come with video walkthroughs and guides on how to fill them out. And they come with free support too. So if you've got questions while you're filling out, you can let us know. But using a tool like this can help you really see what your cash flow is going to look like. How many months are you going to need to cover that until your cash flow positive on the month-to-month basis? And so that's one step of this, is just understanding the cash flow model and projecting that out. Point number 2, or point B of this one we're talking about right now, is ways, things you need to kind of keep in mind about the cash flow is going to be, 1, consider keeping W-2 or full-time income or outside income for as long as you possibly can, even when you're starting the business. A lot of people think that what their loan officer wants to hear is that the person is willing to quit their job and focus on the business full-time. Sure, there are some circumstances where maybe that's necessary, but if at all possible, if you have the option to work part-time or work full-time and hire someone cheaper than you to help do some things in the business or whatever you need to do, or moonlight, or do it on the side, or just work 100 hours a week to try to make it work beginning, that alleviates pressure on the business to be able to cover what it needs to do. It alleviates the need for the business to pay for you and pay for the business and pay for a loan. And so encourage you to try to think about what you're willing to do on that front. And the last part around this is lenders are going to look at what's called a debt service coverage ratio. Their target is for that to be at 1.25 or higher. And essentially what that means is they're trying to indicate, so if you have a 1.25 or higher, you're indicating that the business is generating 25% more income than is necessary to cover its debt obligations. So they're trying to basically prove once the business pays for all the things that it needs to do in the business, there's still enough money left over to make its loan payment. And so the higher that number is, the more comfortable the bank's going to get with that. So that's a number you want to keep a look for. It's a very simple calculation to do. And when our projection templates will help you calculate that as well. So that was a big point. But number 5 is just understanding your cash flow needs beyond your startup costs to understand how much money you're actually going to need to make this project work. And point number 6 is going to stay in the projections. And this is a common mistake, very common mistake, is having unrealistic or inaccurate financial projections or financial statements. So if you're an established business, let's just think about this on the financial statement side. You really want to make sure that your financial statements are updated and they're accurate. So if you're working with an accountant, presumably, you should consider not just working with them at tax time. Have a bookkeeper, have someone working on that, keeping that updated. Try to limit the number of entries that are categorized in the Ask My Accountant category, and make sure there's not confusion around any line items in your financial statements. So you should be able to explain everything, attribute everything, and feel really confident about those. Make sure your balance sheet balances. A lot of basic things that can really hurt, your chances with an SBA lender. And for expansions or on the startup side, your financial projections, you really want to make sure they're realistic, within industry norms, make sure they're accurate. So using a template like this is going to really help as far as accuracy is concerned. So making sure, because it's already set up to do all the calculations for you. It's going to do all these financial statements for you already. And I'm trying not to sell this too hard. I don't want it to come across that way. It's just a good tool for me to talk about this point. But these templates are set up in a way where, based upon your specific industry, we've got these information we put. So this is geared towards a gym, right? So we've got a section here that talks about member acquisition. So we only edit these blue boxes to try to figure out how many members we might have. We've got different plans we can group these people into. So we're only editing these blue boxes if we want to sell merchandise and food and drink and that kind of stuff. And then we put in our expenses that we're planning to have each month. Are we going to have any employees? And then it does the rest. It calculates all these financial statements for us. And so as far as accuracy goes and reliability, using a template like this is going to be helpful to make sure, things are being calculated properly. But a big step you need to do is doing some research and some benchmarking. Another great thing about using a tool like this is we have all these really key financial numbers, right? And all we have to do is go out and look to see how do those compare. So a big one I like to do is net profit. So profitability, right? Let's look at our net income. Obviously in the first year is kind of a wash because you have high expenses, but 11%, 17%, 20%, 23%. So let's see how that compares to the industry. So you could use a tool like a ChatGPT to ask for numbers like this. If you don't trust those types of tools, you could just go to Google and just do some scanning. So I can see profit do they make per month? 15.5% was the median. Some registered profit margin of 20%. ChatGPT says net profit 10 to 20%, gross profit 50 to 70%. So if I go back to our template here, we're not far off from that. Profit margin 11, 17, 20, 23%. So I at least know we're not crazy, right? We're kind of within the range. So you can do that for any number in your set of projections to really make sure it's dialed in, because you really only get one first impression when it comes to the financials. And although you can always change things, it's never a good sign to your lender if you give them one set of financials and they express some concerns and it comes back and then the numbers all look different. Tweaks are okay, but massive changes, you want to try to avoid that. So doing this type of practice is really helpful beforehand. And let's see here. Let me just pull something up to be in the background here. And then lastly, I'll say for mistake number 7, and that's going to be overlooking the importance of personal credit worthiness. Now, it's, most people probably know this, but your personal financial situation, your personal credit situation impacts your ability to get a business loan. I think sometimes people just surrender to the fact that maybe they're not able to get it together on the personal side before they get into the business. Or they'd like to try to keep personal separate from business, but that's kind of a myth as well. And so this might sound like really cliche advice, but your personal, financial, and your credit situation are probably equally as important as anything that goes through the business. I wish it wasn't that way. I wish people could only lend off the merits of a business plan or an idea. That's just very uncommon anymore. And especially if it's a startup, they're placing so much of their decision based on you personally and your strength personally. So some examples: do some work on your personal credit if you can beforehand. So dispute some different items on there if things shouldn't be on there. Don't fall into one of those traps where you pay somebody to improve your credit. Those never work. So, try to improve that as much as you can. Be prepared to have an explanation for any poor credit items on there, and truthful explanations, not excuses. So repairing credit takes time. So in the event that, you've disputed the things that you can, be prepared to talk about what's on your credit report. A really tricky one, and again, kind of cliche, is have some cash saved. If you cannot save any money to help in starting the business, it's probably going to be hard to start a business in the first place. SBA loans are going to require at a minimum 10%, what's called owner investment. So usually the best way to calculate that's going to say, if you need a $200,000 loan to start your business to cover everything, you're going to have to probably be able to come up with 20,000 of that, right? The lender's not going to cover 100% of the proceeds of what you need. So calculate what 10% of that's going to be, and you need to be able to come up with that to invest that into the startup. And lastly, line up a cosigner just in case. Nobody really wants to have a cosigner, but that really can be the bridge to gap lender discomfort whenever your credit situation is not in a great point. So look for someone who has strong credit, income not attached to the business, and consider asking them in advance if you need a cosigner, would they be interested in doing that? And just have that lined up. So there you have it. That is 7 kind of common mistakes people make when going through an SBA loan application process. I feel like I could list 15 of these or 20 of these, but we'll keep the video right where it is. So if you have, or if this was helpful, please give the video a thumbs up. That's helpful for us. And if you have questions, just leave it in the comment down below, or if you feel more comfortable, you can contact us directly at support@projectionhub.com. And go down to the description, get all the resources, grab your application link, the lender link, all the different things. We hope you use those tools and that they're useful for you. And we'll see you on the next video. Thanks.